When it's PCS time, you know the drill. Pack, research the new base, get the kids in school, because family supports family. At American Public University, we support military families with flexible, affordable online education that moves with you. As a military spouse, your tuition rate is the same as your partner's, just $250 per credit hour. American Public University, education that moves with you. Learn more at apu.apus.edu/military.
This is Scott Becker with the Becker Private Equity and Business Podcast. We try each day to make sure our listeners they learn something and they're entertained, a little bit of both. But we're on today with one of our most listened to regular guests, Matt Wolf from RSM. He's going to talk to us a little bit about what people are talking about for the deal outlook for 2025. Matt, let me ask you to take it away. And RSM, by background, is one of the leading firms in sort of the mid-market business in depth in practice. Matt, tell us what you expect for next year. Then I'll ask you at the end of the podcast to tell us a little bit more about RSM.
Yeah, thanks, Scott. As we close out 24, looks like we will be on basically a flat year in terms of deal count and actually kind of down in terms of deal volume, fewer large deals than we had last year. And, I don't think, nobody's going to call us crazy for saying we expect that to improve in 25. There's certainly some unknowns in terms of the pace at which the Fed lowers interest rates. We'll see. There's some talk that maybe that'll be a little bit slower than some people expect as a response to potential tariff-induced inflation. So there's some uncertainty there. But, really, when we look outside of the sort of monetary policy and we just look at what's driving capital markets, we're at this inflection point where I think by and large, sponsors and other investors have sort of accepted the fact that they're going to have to exit investments that they've been holding on to for a few years, waiting for higher multiples, better valuations. And there continues to be a huge flood of new money into private funding vehicles, particularly into private credit. There's just a lot of dry powder out there that will seek deals. And, we've had a few hiccups in the equity markets, but if the public equity markets can remain strong and remain robust, we may even see a return in at least some industries of sort of IPO activity. All of this will encourage deal making, certainly the large deals, but also within the middle market. We've talked about this before. We're continuing to see this. However, I have to add my caveat, my asterisk, that the deal market will look different. I expect we will see more announced deals, more completed deals in 25 than we saw in 24 in the middle market. But that isn't going to tell the whole story, because sponsors, buyers, sellers are going to spend so much more time on diligence, and we're going to see so many more deals that never get announced, that never get closed in the middle market because the buyer and seller just can't come to an agreement, whereas in the prior cycle they probably would have. Going forward, there's just as interest rates remain high, there's a much lower margin for error when it comes to deal making, and we're going to get a lot of at-bats, but that average is probably going to go down. We'll see more deals completed, but it's going to take a lot more work to get that number of deals done.
It's so interesting what you say, and I think there's two headlines I saw this morning. One, that there's people selling out of some deals that they bought for the billions for peanuts, which is an overstatement, but what a Bloomberg headline, and some truth to some of those deals that were bought for a ton of money and they've got crushed on them. Second is people expect the largest deal volume I saw in Reuters this morning next year that we've seen in 4 or 5 years. So that's a good sign. But your point on this, in the mid-market, in tough margin businesses that aren't growing really, and you layer on debt, we're probably seeing for the first time in a lot of investors' lifetimes, particularly younger investors and bankers and so forth, seeing deals that there won't be a second bite at the apple, where things won't go as expected. And it's a very bifurcated world. There's plenty going great, but particularly in the lower margin businesses where they've piled on debt, I see more challenges, more legal, more problems than I've seen in a long time. And there's also this pent up desire to do deals. So you've got this a number of fascinating factors at work, don't you?
Absolutely. And I think that, speaking to just sort of the career timeline tenure of many of the advisors and the investors themselves, right, is like, we haven't had this kind of environment for really 15 years. So there's certainly senior professionals have seen this before, but even for them, it's been a long time. And we sort of liken it to, everybody likes to compare capital markets with buying and selling homes, I think, because everybody's very familiar with that process. And there are some good analogies there. And it's, if you're thinking about buying a house for sale and then flipping it to sell, in the past environment, you could maybe slap on some new paint, redo the cabinets, you're fine. Going forward, to really make that money, you're going to have to find the homes that you can buy at a discount, but maybe the foundation's cracked. And so you got to put real money into that. We're going to see fewer sort of platform plus tuck-in plays and more fixer-upper type plays, particularly in the middle market. And yes, and it won't be able to be quite as levered. We have been seeing some deals though, which I think is really interesting, where part of the funding might get a revolving line of credit, but that line of credit isn't necessarily for making an acquisition. It's for investing in a new ERP system or a data warehouse, data lake environment, so the company can generate improved operational efficiencies, improve that margin, improve that cash flow, and they're turning to private credit for some of those financings. So definitely a shift. It's a new playbook for most everybody, like you point out. And even if you've been through this kind of cycle before, it's certainly been a long time. And last time we saw this, we didn't have generative AI. We didn't have a lot of technology that's going to really change the game going forward.
No, I think there's a couple of things you said there that are so interesting and so right on. When I look at the investment world, the typical private equity business or investor wants to invest in a healthy company that's got good margins, that's growing, but they think they could add some things to supercharge it. But they're more looking at 10 to 50% outcomes, returns, than they are on binary investments. And when you start to get into companies that are losing money or need to be turned around, the probabilities go down. I mean, the upside could be bigger because you might be able to buy it cheap, but the chances of making it successful go down from buying a business that's cash flowing very nicely and doing well. So you've got this very interesting situation where the private equity is forced to move into a part of the market to do big things where sometimes things aren't as healthy as they'd like them to be. So that's one. The second thing I think fascinating is the binary world has always been more the world of venture capital than private equity. And now you've got this interesting sort of mix there where venture is still quite active. They understand they're going to invest in X things. There's going to be a few that really drive their returns. The private equity market, as it gets tougher to find good mid-market deals, it's going to put a premium on good deals, and it's going to put a lot of stress on private equity investors on okay deals. It is fascinating to watch.
Yeah, I couldn't agree more. And we've seen in reaction to that, a lot of what I would consider sort of leading sponsors really reevaluate their investment thesis and really sort of expand, reevaluate their operating partner bench. So we've seen some, and I work, for example, a lot in healthcare. And so we've seen some sponsors say, okay, well, we used to do a couple deals with services a year. We had one operating partner kind of help us a little bit on the diligence side, and that was sort of it. And they're saying, we're just going to abandon that now. Like we're not going to invest, or we're not going to invest the time and resources to be really good at finding those fixer-upper opportunities when it comes to healthcare services. And we're going to go back to focusing on our core healthcare technology plays that historically we've been very good at. We have a depth of experience and expertise on these, and we think that there in that niche we can really add value and work on these kind of fixer uppers. So being very focused about what deals we even look at will be, I think, critical for most investors going forward.
No, thank you so much. I think that's exactly right, and you're absolutely right. If people don't live in an area, they don't want to spend the time on the learning curve in it if it's not likely to be a fruitful area. And like a lot of things, people could say it differently, but often PE funds invest in packs. So when an area feels hot, a lot of them are in the same area, and they don't want to be caught looking at an area that's contrarian. Even though there's all this talk historically about contrarian investors doing great, that's not the world of the private equity fund by and large.
Absolutely. And that strategy, call it herd mentality or pack mentality, whatever, I don't think not that cynically, but, in the prior market environment, like that worked fine, right? When money was basically free, you could, if you were quick to move and quick to capitalize on, just an undervalued company from a pure financial engineering perspective, you could make a lot of money doing that. And that was definitely the skills that ruled the day, prior to 2022. It just won't be the same way that top firms generate returns going forward.
Could not agree more. Matt Wolf, again, Matt's with us as a regular guest. We're so excited that he'll join us again next year. He's one of our most listened to people. RSM, the very best in the middle market. Matt, take one moment and talk about the RSM private equity practice, if you don't mind.
Yeah, happy to, Scott. I appreciate that. We live and breathe in this environment, and what I think differentiates us compared to a lot of our competitors is our focus on industry. Our teams are aligned by industry. We focus on the middle market, which is fairly broadly defined. And yes, in certain capabilities, we can scale up, we can scale down. But at our core, we really take an industry-based approach to serving the middle market, particularly sponsor-backed entities and the sponsors themselves at sort of the fund sponsor level with a variety of value-added solutions. It's how we've established a name for ourselves in the marketplace, and it's something we can continue to execute on and is very core to our sort of being here at RSM, is being that industry-focused middle market private equity advisor.
Thank you. I've had the pleasure of watching the RSM practice grow over the last 20 years. I hate to date myself. Somebody was on a podcast earlier today and said, well, Scott, you've been around longer than me, so you've seen a lot of this. And I was like, what the heck? Do I need that today? But I've watched RSM over 20 plus years grow this practice. It's been nothing short of remarkable what your team has done. I will admit, not only am I a fan of theirs, we've been a client of theirs, so we're big fans of RSM. Again, thank you for joining us on the Becker Private Equity and Business Podcast. Thank you.
Thank you.
When you're part of a military family, you understand sacrifice and support. So at American Public University, we honor your dedication by extending our military tuition savings to your extended family. Parents, spouses, legal partners, siblings, and dependents all qualify for APU's preferred military rate of just $250 per credit hour for undergraduate and master's level programs. American Public University, value for the whole family. Learn more at apu.apus.edu/military.